Joyeux Noël.
What are we, French now?
Hardly, but what are we talking about today?
Yeah, it's the end of the year, so I think it's a good time to just do some year-end financial items we should all be aware of, and then kind of, our biggest takeaways from 2025 and forward looking into 2026 here.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it.
Okay, year-end recap. We're doing the Spotify Wrapped of podcasts.
That's your favorite?
I don't mind it. It's a neat little feature.
So let's just start off with actual financial planning items prior to the end of the year that we could still take advantage of and we should be aware of and make sure we're firing on all cylinders on and still have the time to do something about. So I think first things that kind of come to mind for me, we've been talking about with clients tend to be things like employer funding of sponsored plans, things with portfolios, contributions to accounts, Roth conversions, charitable donations and giving. Anything you want to expand on there or things you think I'm missing?
Just do all of that. Sounds like a terrific list of things to make the end of your year work out really well.
All right, easy enough. Great. So nothing to add there?
No, just a couple things. On charitable, I think the biggest thing that we need to talk about or think about is just charitable bunching. One big beautiful bill passed this year, and that really has changed the name of the game for charity. So quick recap of how it works right now and how it's going to work starting next year. Right now, to get a benefit from charity, generally speaking, you need to be an itemized filer. This means we need to be paying, $20,000+ in taxes or other fees or expenses on the individual side, 30+ on the married side. And generally speaking, most people doing little gifts here or there really don't get any benefit out of it. There's some state level stuff. There's child tax credit things and whatnot here in Colorado, but just generally speaking, it's not really that big of a deal for a lot of folks. So right now, for a lot of people to get the benefit, they kind of got to be itemized filers anyway. We're financial planners. We work with a lot of itemized filers. So the big difference now that we have to look forward to going forward is that starting in 2026, your donations will have to exceed 0.5% of your adjusted gross income. So you're making, let's say, $300,000 as a household. You would have to donate at least $1,500 before you were able to deduct anything from it. Conversely, if you're a standard deductor, historically you've not really gotten any benefit for it, but going forward for individuals, you can get a charitable donation deduction for $1,000 or up to $2,000 for married couple without having to itemize. So that puts some emphasis on doing a lot of big gifting this year if you're an itemized filer instead of breaking it up year over year over year for the next couple of years. And if you're a standard deductions person, kind of makes sense to wait till January.
Sure. Yeah. That's pretty cool that standard deduction filers can probably get some sort of tax benefit for making those donations now. Isn't there also something I believe we talked about on the state level for Colorado that impacts charitable giving moving forward too?
Well, so the bigger thing there is, for Colorado, and this sort of goes into the same categories of people who are likely to itemize versus do standard. Colorado did change their standard deduction system where if your household income is greater than $300,000, whether you're an individual or married, doesn't matter which, that your standard deduction starting next year essentially drops to nothing. It's essentially $1,000. So with that, that will still apply for standard or itemized. They're not just going to let people who itemize sort of mulligan their way around that. But Colorado does have some really generous terms around charitable gifting. They had a provision where you could donate up to $300 and get a deduction for it, even as a standard filer. And then Colorado has a very generous child tax credit charitable giving thing where essentially if you do a donation to a child supporting charities like orphanages, after school programs, early youth education programs, etc., essentially you can get your deduction plus an actual state tax credit. So it's really, really beneficial to donate to child related nonprofits here in Colorado.
Cool. So sounds like charitable giving this year if you're going to itemize moving forward, and if you're taking a standard deduction might make more sense to wait till next year. I know that's a specific call out from the big beautiful bill that was passed earlier this year. Are there any other legislative items from that bill that kind of come into effect next year that we should be aware of here?
I think a big thing here is just that kind of all the green tax credit stuff is essentially dying or already gone. A lot of it ended back in September. Some of it clung on until the end of this year. State of Colorado still has a couple of things for green vehicles, but the federal incentive, which was the bigger incentive, is completely gone at this point for electric vehicles. Same thing with a lot of things like solar, energy insulation. There's still some state level programs, but all the federal incentives are essentially gone, probably going to be gone at least until 2018, 2019, assuming there's an administration change. So it's sort of going to become a bit of a slower period for those sorts of things. Now, if you still want an electric car, if you still want solar, if you still want to do better insulation in your house, all that sort of stuff, it's fine. We just don't see the same tax incentives for it.
Cool. All right. So I think the only thing we haven't really talked about for year end is just like RMDs for those who have them. Is there anything specifically you'd give people maybe some tips or just insight into in regard to the RMDs and taking them before the end of the year here?
Yeah, so if you are 73 years old, if you turn 73 years old this year, you're required to take your first required minimum distribution. Now that's technically due by April 15th of the following year for your first year of RMD. So if you turned 73 this year, happy birthday. Your RMD is due by April 15th next year. But if you take it out after 12/31 of this year, so you take it out 2026 instead of 2025, then you're going to end up with 2 RMDs in the same year. So individual circumstances dependent, probably going to make more sense to go ahead and take it out this year. Now, with that in mind, if you don't need the money, and that's not to say that anybody doesn't need the money for one thing or another, but if you find yourself kind of looking at your RMD and going, I don't really need this, or like, what am I going to use this for? Or I guess I'll just reinvest it, like whatever you're thinking of there. Back to the charity conversation, you could do a qualified charitable distribution. This lets you donate directly from your IRA to satisfy your required minimum distribution directly to a 501c3 charity. If you take that approach or that route, then that's going to be your best, kind of your biggest donation and your best net of tax effect. You don't have to donate your entire RMD, and you can even donate more than your RMD or less than your RMD, it doesn't matter. But if you want to donate something from your IRA distributions and you have RMDs this year, that is a way to get around it, give to charity. And if you really want to triple dip, right, donate to a child-related nonprofit in Colorado, and you're going to find yourself getting probably the best of all worlds around that.
Sounds like an opportunity to have your cake and eat it too. And remind me, Dan, I believe the RMD age, right? So starting 73 for a lot of folks nowadays and going up to 74 or 5. But for the qualified charitable distributions, those can start as early as 70 and a half. Am I wrong?
They can, and so that kind of creates a weird scenario where you don't have to take anything out. So the only real case where that's going to make more sense is we're trying to do things like Roth conversions, or we're trying to reduce our pre-tax retirement account balance. We're old enough to start doing these QCDs, and we go, okay, I wasn't going to have to take an RMD out this year anyway, but I was planning on trying to get more money out of my IRA to work on that sort of RMD tax bomb some people experience. So as part of that effort or that ongoing, activity of trying to reduce my pre-tax retirement balance, I'm going to go ahead and use a QCD to get more money out of my IRA and give to charity at the same time.
Got it. And remind me, the penalties for not taking your RMD when you need to are also quite steep, right? I believe they changed it recently. It's what, a quarter of the RMD you missed plus still taking the RMD?
Yeah, you still have to take the RMD, you still have to pay the taxes, you lose the QCD opportunity for that particular year because you can't mulligan it back with a QCD after the tax year is over. The penalties are not as bad as they used to be. It used to be 50%, now it's 25%. I'll also say in practice, I've seen a lot of clients come in who missed an RMD or didn't take an RMD, right? And these are cases before we were working with them, but like, oh gosh, I didn't do that last year, oops. Or, they show up, to become clients of the firm really, really late in the year, and they might move their IRA over to us or something like that, but there's been some communication challenges and they haven't told us whether it's been handled or they thought it was handled, but it wasn't. All of that to then say, I've seen a lot of first-year RMD mulligans out there. There is a form you can submit that you can submit to the IRS, essentially stating like, "Hey, I did not take my RMD. I am now taking my RMD. Please give me a pass on this." I've never seen the IRS enforce that excise tax. That's not to say they won't. Talk to your tax preparer, take your RMD on time anyway. But if you do miss it, particularly on a first-time miss, particularly in your first year for RMDs, it seems like the IRS is predisposed to be a little bit generous about that.
Yeah, knock on wood. Let's hope they keep it that way.
Done.
So those are like the tactical and more technical items before year end. But there's also some, I think, softer, less quantitative things that can happen before year end, right? So like this time of year, we tend to see a lot of family, right? Have those conversations with some family members maybe that we don't have every week with our friends and people we might live closer to. So, there's kids, there's parents, and by me seeing all these folks in one place, there might be some great opportunities for some lovely conversations around money. We've mentioned and talked about before how kids specifically learn from what you tell them about money, but they also learn from the things that they see and observe. And this is a unique time of year, right, where they might observe a lot, whether it's gift giving or, getting gifts for people. Is there anything you'd want to mention here in regard to like good things that you have the opportunity to teach them this time of year versus maybe some of the things that are wise to avoid or that you might not even realize they're picking up on?
I mean, I think there's sort of the obvious, positive human spirit things here, right? Being generous, right? Giving to charity, volunteering time, being part of your community. I think those are all, very positive things that I think people are predisposed to do during this time of year anyway. I think some things to avoid, or at least be a little bit more conscientious of. So, for example, there's this sort of classic phenomenon, right? Where it seems like, gee, Santa sure is nice to the rich kids and not very nice to the poor kids. There's sort of that peer-to-peer thing. Your kids do recognize that. They may not understand why it's happening, but they're not clueless. They're going to notice that the rich kids got, a PS5 and all the things they wanted, and that, the poor kids didn't really have much to brag about or talk about. I think it's important that if you're going to give big, substantial, or material gifts, that those are not coming from quote-unquote Santa, right, or from mysterious supernatural forces, however you want to think of it. I think it's important that if you want to give something really nice, really expensive, whatever it is, that you're clear, right? This is coming from your parents. This is not coming from Santa. Santa leaves cookies, candy, little trinkets, things like that, but not big expensive things. I think that's a helpful thing because it gives you an opportunity not only to avoid giving your kids social anxiety or social inequity problems that they have to sort of recognize in their peers, which you can't prevent all of, right? Their peers are going to do what their peers do, but at least you're kind of not contributing to that issue. But then also it becomes an opportunity to sort of give recognition, right? Hey, like, we have done well. We are giving you these gifts, right? And so I think it's meaningful to go ahead and be deliberate in the gift-giving portion of this season and trying to be, conscientious of the unintended message that giving gifts from you versus giving gifts from supernatural religious entities can kind of convey to your kids.
So you're saying even if you have a kid that still believes in Santa, you should make it very clear which gifts are and aren't from Santa?
Well, some families will do the thing where gifts will say, like to Johnny from Santa, and then, other gifts will say, to Johnny from mom or dad or whatever it is. I think it's important that the gifts from Santa are not the biggest, most extravagant gifts, because that is going to send the signal, intentional or otherwise, that, Santa really, really loves and cares about this kid, and you'd love them to have that message. But then it sends the unintended signal that when their friend who's maybe their family's not doing as well right now, their friend doesn't have anything to brag about in that same way or share in that same way, it sends a signal, right, that, I must be a good kid, my friend must be a bad kid, but that's not really what's happening here, right? Like, you brought the gifts, you got them the gifts. So I think it's meaningful and important to, again, just highlight that anything big and substantial is coming from family, right? This is from mom, this is from dad, this is from your uncle, whatever it is. And that anything, again, cookies, candies, little fun things that go in the stocking, that sort of stuff, like that can be from Santa, but we shouldn't be giving kids, $100, $1,000 big expensive stuff from Santa, because again, that's going to create a weird peer dynamic that we don't think of. We're just being generous and loving our family, but we have to remember that children obtain financial lessons and financial messages intentionally and unintentionally.
Yeah, that's an interesting one. I don't think I would have thought of that on my own, like gifting as the parent versus as Santa. And I think there's an interesting point you bring up there about who gets kind of the responsibility for giving you the gift and maybe not putting it all on this artificial being. And I think that's wise. What about like giving them things versus experiences? I know we talk a lot with clients. So we have some clients that love buying things and others that enjoy more the experience and the memory it provides them. Do you have any opinions here on maybe what's more valuable? Because I know a lot of kids, I think they probably just want things, right? That's pretty common for kids, especially when they're younger. Do you impress upon them the value of experiences or think it's more valuable to just give them kind of what they want, what's on the list?
I think there's a best of both worlds thing here, right? You're going to give them some experiences, you're going to give them some things, but I think the best answers are actually things that create experiences, right? Hey, I got you skis. We as a family are going to be going skiing. Hey, I got you a PS5. I also got some couch co-op games we can play together as a family, right? So it's okay for there to be things, right? Half the fun of holidays is unwrapping these gifts and seeing what you got and whatnot. Like that's the really joyous part of being a kid. But I think, rather than sort of entirely standalone things, there's that. And then there are things that are experiences unto themselves, right? Like I would argue a book is an experience. Yes, it's a book, but it creates this, vivid, story or experience that you get to enjoy from it. So I think that's just the thing to look at is try to be conscious. And you know your family, you know your kids, so take this all with a grain of salt. But I think if you're trying to be conscientious about what's going to create the best, happiness or the greatest longevity, it's going to be stuff that is shareable as opposed to things that, just send your kid up into their room and you'll never see them again.
I like that. Yeah, I mean, we say like experiences appreciate, but things depreciate. But, you can kind of have the best of both worlds, as you mentioned, right? Like even buying them a bike technically will depreciate, but also probably, there's a memory there of learning how to ride the bike, the time it took, the scrapes and falls along the way, and the happiness you had when you finally were able to take off the training wheels. So I think that's pretty good there. So last thing on this item, I just have something written down here that says fun and constructive money conversations to have with family. So does this mean when I'm home, I should grill my parents about long-term care and their estate plan?
That's a dangerous question to ask, Daniel, because deep down, the answer is recognizing that might be a bit of a buzzkill for the holidays. It is probably not a practical thing to talk about. I think you want to be conscious of the unconscious signals that the holidays are already sending, right? You know your family, you know your dynamic. It's easy for us to just sort of sit here and be like, just do this and everything will be great. But, family's complicated. Life experiences are complicated. Money is a tough topic for a lot of people. So I think if there's an opportune reason or thing to talk about, things, coordinating conversations are better than like post-Christmas unwrapping conversations. So, talking to, let's say, your parents, the grandparents of your children, and saying like, hey, we're thinking about doing this for them for Christmas or for Hanukkah or whatever holiday we're trying to celebrate here. I think it's meaningful to do that and collaborate. Because that can also provide an opportunity to get an insight into what we are doing, what they are doing, and if there are things that maybe should be discussed later at a more appropriate time, right? You say, hey, we're thinking about getting them this set of stuff so they can have these experiences. Let's say it's ski stuff. So we're thinking we'll get them the skis and the boots. It'd be great if you could get them the helmet and whatnot. And if they're all on board, great. But if they come back and say, oh, that wasn't really what we were planning on, then there's a conversation to be had here about, well, okay, what were you planning on? Maybe you had a better idea than us, or maybe there's a signal here that that's a financial thing they were not ready to commit to or able to commit to. So I think it's a thing where it's useful for gaining some context into your family's lives and situations. But two things here. One, don't ruin your holidays by suddenly just getting into a deep long-term care conversation. And then two, be mindful that the holidays can create a pressure to keep up with the Joneses, and that sometimes people are going to go out and beyond their financial bandwidth or means, quote unquote, because it's the holidays. So just being mindful that there's constructive things here, but also that, cultural, social, family pressure can sometimes put people in uncomfortable places, and trying to just be mindful that you do or do not do that to others.
Well, I think even to the last point there, you see a lot of people that do that, right? It's the holidays. Yeah, I spent more. And you definitely see the holidays kind of amplify some of their spending habits, in part just because, well, I know my neighbors and friends, and I know how many gifts they get people every single year. I have to do that for my family, even if they don't maybe see the direct comparison. There's like an underlying premise there that you'll do the same and reciprocate that. Is there a way to kind of not do that besides just like saying don't keep up with the Joneses? I mean, it's kind of easier said than done, I feel like.
As a financial planner, I think the easiest answer to this is just have a plan in the first place, right? If your plan was to spend $500 on gifts, great, do that and don't feel bad about not doing it. just be mindful of whether you're going for a quantity versus quality or quality versus quantity approach, because if you try to do quantity at quality or quality at quantity, that can be the thing that sort of tips you over the edge there. If you just sort of have a loosey-goosey approach to holidays where you just sort of get people what you feel like getting them, oh, that's great and fine. Just be mindful that everybody else is sort of on the same page, that you're not sort of love bombing your friends and relatives or your family members, and they are kind of on a different financial scale than you are.
Yes. All right, cool. Well, for anyone that listens to the podcast semi-frequently, we did a podcast episode recently on getting raises. That conversation didn't work out for me, so everybody's getting macaroni salads this year. Getting macaroni necklaces this year.
I would take the salad over the necklace if we're being honest.
No, they're getting the necklaces.
Bummer. But sorry, it's to be.
So all jokes aside, I think that's a really good place to leave it. So now, like, kind of just looking back on the year we've had thus far, a lot of really good client conversations, a lot of good and bad current events, things that took place, a lot of money saved, money made, catastrophes avoided, etc. I guess I'll just leave it up to you. Where do you want to kind of bring this conversation? I guess what to you stood out this year a little bit?
I think there's a lot of different things. I think the most obvious thing is just what is on clients' minds. What conversation trends have we had throughout the year? I think early in the year we heard a lot of concern about the change in administration, right? What that meant for domestic policy, international policy, finances, markets, all of that stuff. It did not help that we sort of had the tariff issues pop up early in the administration, where the market suddenly dropped, 10% in a week, and that scared a lot of people. That conversation has sort of eased off. I think people have sort of gotten used to the administration, used to the conditions. And some people, to be perfectly fair, right, are on the other side of the conversation and like, I think it's all great. So all that said, right, some people didn't have a care in the world. Some people, it was a source of really deep anxiety. It feels like those conversations have become less frequent as the year has gone on, but that was something that was really, really predominant early on. Today I think we're in a little bit just sort of the new normal as you get to, throughout every presidential administration and congressional administration and so on. So I think that's sort of the most obvious thing, is that there was a lot of anxiety this year, and it seems to have tapered off reasonably well. But hey, it's something that I'm sure is still on some people's minds.
Oh, it's definitely still on some people's minds. But in regard to the tapering off, do you think that's literally just because, like, we've now accepted the new norm for close to a year at this point, and things kind of just settle down a little bit and we become comfortable with that? Or do you think it's something deeper than that?
I think there's two things to this. One is that you do just become comfortable to it. I think the other thing, and this is going to sound a little bit hyperbolic, so take it for what it is. But there was a video from a legal channel I watched the other day that just highlighted, here are the 200 crimes the administration has committed. And just went for 45 minutes, just sentence by sentence by sentence, and then they did this, and then they did this, and then they've done this. Some people listening are going to roll their eyes, but crimes, it's sort of overstated. Some people are going to be like, oh my gosh, 200, wow, I had no idea it was so many. I'm not really here to make a comment on that, but I think, there's a thing where you can become inoculated to anything that happens enough, right? You live by train tracks, Daniel. I'm sure the first night you were like, holy shit, there's trains that go by here. This is nuts. I'm sure today you don't even notice. So I think it's just this piece where it doesn't really matter whether it's good or bad or what the source is or whether you think it's valid or not. There's just a thing where, anything that is a stressor the first time is probably the worst stressor that it is. You can kind of escalate or kind of build up, but the longer something goes on, the less it becomes noticeable to you.
Do you think there's a planning lesson in there somewhere? Something along the lines of, don't make long-term decisions based off short-term events or something? Like, what do you think there's something we can learn from that there with clients?
I mean, I think you just highlighted the lesson. It's sort of that thing of the classic Benjamin Graham thing about Mr. Market, right? And for anybody who's not familiar, Mr. Market is just a reflection of the news about the market. Mr. Market's this caricature of a person who just shows up at your house every single day, screaming, "Oh my God, you've got to buy, you've got to buy, you've got to buy," or the very next day, "Oh my God, you've got to sell, you've got to sell, you've got to sell." And the whole point here is that you can emotionally latch on to any specific current event. It can be political, it can be economical, it can be environmental. But the problem is, the market is not that interested in singular events, right? It is a mechanism for the aggregation of positive or negative sentiment about the future value of the collection of companies and organizations that make up the market. So in that context, it's something where it's easy to see a problem in current events and go, gosh, maybe I should do something about that. But it turns out just sitting back and letting things run tends to work best. There are definitely short-term events, right? Back to tariff stuff. If you knew the tariff stuff was going to happen a week prior, you would have done really well to just get out ahead of it and then to buy back in, a week into it, because it turns out that was about when the bottom hit. But it's something where, nobody has a functional crystal ball. And in that respect, understanding human limitations, it turns out everybody who just stays invested long-term does just fine. It's the people who get, reactive, who look at current events and go, gosh, this is a reason to do something, that often end up being worse for it.
All right. So sounds like, as we've said before, and we'll probably say again, setting it and forgetting it kind of beats market timing for the majority of folks out there. Are there any other more tactical planning items or strategies this year that now in hindsight we realize maybe worked better than expected, or just kind of reinforce the principles we already have?
We made a pivot to longer term bonds essentially 2 years ago, anticipating, okay, the Fed's done raising rates for the foreseeable future, so yields will start to normalize over time. So we went ahead and kind of went from short term back to longer term holdings. That has paid off well over the last 2 years, and has paid off pretty well this year, just because the Fed has then gone to the exercise of slashing rates over the last 2 years. So it's something where we kind of got into that early, and now that's proving reasonably beneficial. Bonds are not a sexy category of investment by any means, but that's sort of a category where sometimes people say, like, how are you going to react to current events? And we say we don't like to stand in front of moving trains. We don't want to hold long-term bonds when rates are going to go up. We don't have any benefit really from holding short-term bonds when we think rates are going to go down. And so it's sort of a very slow-moving tactical orientation, but that has worked reasonably well this year. I think also reshopping insurance has been a remarkably big thing this year. We typically try to do that with clients every year. Most years after the first, kind of re-implementation, people are pretty comfortable for the time being, but we've seen a lot of changes in the risk marketplace, not just here in Colorado, but, around the country. A lot of costs are going up. You're seeing homeowners go up. You're seeing auto go up. There was tort law reform here in Colorado in the last year. So now liability costs and umbrella costs are going up. So, for a lot of people who've been sort of apathetic, it went up 2%, it went up 3%. Suddenly they're seeing these 10, 15, 20% increases. And so it's something where, being indifferent to your insurance situation has proven kind of expensive for people, and being more involved in it has been really beneficial this year.
Yeah, sure has. A lot of clients we're shopping insurance for and seeing some big changes there. What about like internal lessons? You think there's anything from 2025, taking clients out of the situation for a second, and the lessons and principles there? Is there anything internally, team-wise, that, you think you've kind of learned this year?
Tough answers, just because we're a small clan, so when we talk about each other, it's hard to miss who we're talking about or what we're talking about. So trying to be generous in that respect. I think this year has been a year that demonstrated that addition by subtraction was a positive. Literally, the very, very, very first thing we did this year was let somebody go who was not contributing to the team. And that's hard to do, right? You have a personal relationship with people, but it was a decision where we had to say, look, this person is not doing their job, and that's not going to work. And it turned out that was really beneficial. We had another instance throughout this year where we had somebody on the team who was, I think, really trying their best, but their best was not quite to the par we needed it to be. And so we had to have a turnover of that position. And that has turned out to be a phenomenal benefit, not just from a removal of somebody who's not contributing as well as they could have, but by replacing them with somebody who is really over delivering. So I think those have been really big positives, challenges, but positives in terms of the firm experience. And within that, I think there's things that do extend to clients as well, but I'll at least give it a pause here before I talk about client-related things.
Like, you think client-related things in regard to the things you just mentioned, or separate things altogether?
Separate. I think there's some stuff that overlaps a little bit, but separate things.
So you think it's more of like an addition by subtraction sort of thing, and that we've kind of went through a little bit that's been beneficial for us?
This year, certainly, and not all subtractions have been things that I would want or hope for, right? I mean, you bring people into the team that you want to do well and be excellent. And some people are and some people aren't, and some people you think are doing great and they're not, and vice versa. All of that to say, I don't hire people with the expectation or the anticipation that I'm going to be letting them go or counseling them out of a position at some point. But on the other end of that is just sort of a business reality. As they put it to us in the Army, there will be casualties. Not the thing that I want to see happen, but something that you do just have to sort of be comfortable with.
Yeah, that's fair. So what about the other things you mentioned there? You have some other lessons internally that are applicable to clients here?
One is, and clients, I say this with the deepest love, there is no amount of communication that will adequately ensure that 100% of clients do what they are supposed to. And so again, clients, I say this to you with love, but we send out our quarterly invites and our newsletter and our communications, and we share, hey, this is what's coming up, this is what's changing, or this is what to expect, or this is what you need to do. And God bless all of you. I think our success rate on that is like 50%. I think that only tells us that we can only communicate more. We can only try more. So something that we've done, for example, here in Q4, and Steph has championed this, and I think she's done a terrific job with it, is just proactively reaching out to people, a week prior to their quarterly and saying, hey, just so you're aware, we still need these things from you. And, it's funny, right? Because from our perspective, you all the clients know that you need to do these things because when you scheduled your appointment, you acknowledged that you needed to do these things. But life gets busy, things get in the way, or we forget to write it down or whatever it is. And so it's something where we've tried to over communicate more and more as we've gotten into the later half of this year. And I think that's been beneficial, but that's certainly a lesson, as it doesn't matter if somebody, look at sort of that SpongeBob meme where, the guy's like, you see this, I see this, and you agree about this, I agree about this. And so we concur that this is the answer, and the answer is nope. So there's just a thing where I think we have to over communicate and just anticipate that we will always need to over communicate to make sure that we're all on the same page. That way we can make, productive use of the time we spend with our clients.
Yeah, I used to get more bent out of shape about it. Like if I didn't have everything I needed for every meeting, but as I've kind of just worked with more families over time and seen the broad spectrum of preparation they will put into a meeting in advance, I've become a lot more comfortable, I think, like doing things after the meeting that I would have liked to have done prior to the meeting, or, working at a tempo that's more, the client's pace as opposed to trying to instill my tempo on others. When maybe that's not appropriate.
Well, and what we have to remember as the professionals here is it's not about us, right? We are being entrusted by our clients to help them live their best financial lives, and part of that means working with them where they are, not where we would hope they would be. And just helping them progress in that. But that's just something where, it's easy to take it personal when somebody has, quote unquote, forgotten that very important thing, but we have to remember that it's their very important thing, not our very important thing.
Yeah, right on. Well, anything else from the year that you want to share with the team here?
Yeah, I mean, just the other big thing, and we put it out in the newsletters. We've talked to almost every single client about it at this point. But just that shift in our meeting tempo, right, for our comprehensive planning clients, that we're going to go from 4 meetings to 3 meetings. And that is just largely a reflection of the fact that we have this kind of ongoing two sides of a coin problem, where we see a lot of clients skipping the Q2 or the Q3 meetings, and in turn we see a lot of clients not kind of getting ahead or getting in on time for certain periods. Like Q4 is a good example, where we've had a lot of people show up in the last week or two suddenly being like, oh my gosh, I tried to schedule, but it seems like you're out of appointments. And it's like, yes, because we are at the end of the year. There's only so much time before the end of the year, and the calendar has literally become full, where now we are trying to squeeze people into these, like 30-minute periods between other clients' meetings, just trying to get them the help and the advice that they want and need. So just trying to open up the space that we have for meetings, again, going from 4 meetings to 3 meetings a year, giving an extra month to each of those periods, essentially just to go ahead and try to give people a little bit more availability and flexibility, but also in the hopes that, going back to all these other items, that this will sort of improve I'll just call it the compliance rate, so that we can ensure that we are actually getting all the beneficial things done financially that should be done throughout the year.
All right. Well, I'd say my last topic is just like things maybe we learned from the year and what we're looking forward to moving forward. So I guess I'll just use the question you always ask me to start it off. I guess, what have you learned this year Dan?
I think I've learned some sort of like personal or interpersonal takeaways that aren't really like scalable, not things that I can share here that would have any meaning or value to somebody else. But I think more than anything, it is just sort of this reminder of this, that you have to sort of have this keeping on with getting on exercise, that it's easy to wallow in something that didn't work out perfectly or that didn't come to pass the way you intended it to, and just kind of hyperfixate on that particular problem. But life is happening, right? Not just to you, but to everybody, and not everything is going to work out perfectly or align perfectly. This morning, I started my day this morning in the gym listening to a podcast, finding out that a good colleague of mine out in Oregon has cancer for the third time. Not something that was on my bingo card or that I would have wanted for her or wished for her, but something that I now just have to internalize. And that's not my burden. It's not my problem. It's hers, and I wish her the quick recovery and treatment and health. But it's just those sorts of things that pop up throughout the year, and that there's never really going to be a peacetime, right? We sort of have this hope or this dream that we're going to do everything the right way, or we're going to put in the hard work, and that at some point life is just going to smooth out for us. And it's just not really the case. It's part of why I think the value of financial planning always comes around to the activity of financial planning rather than the development of the financial plan. The difference between having repeated conversations and revisiting and rediscovering things versus, writing up one big fancy document saying, here you go. All of that to say, I think I knew all of that, but this has been a good year to sort of reinforce that lesson more than anything.
Cool. Yeah, I mean, I think that's kind of how things go sometimes. Like, we might know it internally, but we haven't experienced it in a while and kind of forgot the message. And sometimes it gets reinforced and just brings it back to the forefront. And maybe it's not something new we've learned, but it's something we have internalized a little bit more.
Yeah, and I think the biggest thing to just keep in mind is, perception is reality. Sometimes it's a curious experience to find out somebody else's version of that reality doesn't match with yours. But that's just something that you have to sort of deal with, right? We're all living our own lives and our own journeys in that respect. But I'll turn it around to you, Daniel, and I know I ask you, every week, every time we sit down, what have you learned this week? But looking back over the course of the year, what do you think your takeaways have been from 2025?
I don't know. I'd say it's probably more along the lines of what you said. It's more like a reinforcing of things you might already innately know but haven't thought about in a while. Like the first is just like, as you mentioned, it's been not a chaotic year, but there's just been a lot going on. I think I've gotten more comfortable, just like, as you said, like there's never a time where it's all like peaceful, right? There's always like, you're always spinning multiple plates and that doesn't like go away. I think I've just gotten like way more comfortable doing that and just been like, oh yeah, no, that's how it is. And like, just because you have bad days don't make bad weeks don't make bad months, and bad months don't make bad years unless you like let them. So it's like, yeah, okay, if you had a bad event, bad meeting, cool, that's a bad meeting. Like, that doesn't mean it has to ruin your day or bleed into personal relationships once you leave work, or just because you had a crappy day doesn't mean you have to have a crappy week or a crappy month, and it kind of keeps going. Let's see, what else? You can just like do things. That's like one of my favorite, like me and my girlfriend talk about that a lot. Like, it's not even a quote really. It's more just like a way of thinking. Like, you don't have to ask for permission. Like, you could just do things, and whether those like personal things in your life or professional things you seek out for, right? So like for me, big thing was like posting on social media this year. Like, you can just wait until everything seems perfect and ask for permission and give that permission to yourself, or you could just like do it, see what happens, and like whether it's that or applying to be on some of the committees for the FPA, or the treasurer for the chamber education committee. Like, you could just like do things, and there's nobody out there that is trying to give you permission for these things. You kind of just do them on your own. And then I'd say lastly, we kind of touched on it already. It's more just like being comfortable in the uncomfortable, or in a space where you're not 100% familiar with everything you're doing, but kind of having just the confidence in yourself to figure things out. Which isn't even really something I've learned, more just internalized, I think.
Sure. Well, and I think at the end of the day, right, that's sort of the adventure of life. It's not a storybook, although it might read like one when it's all said and done. But you get to enjoy the bumps and travails and the highs and the lows, and hopefully the highs outweigh the lows.
If we're lucky.
Yeah. Yeah. Well, as you like to say, not so bad if you like perfect.
So what about 2026? Tell me something you're excited about as we look toward the new year here.
And I think the most obvious thing is that we have new team members joining us, right? We're having somebody that's join us in January, expecting somebody to join us in June, and that's just something really exciting to look forward to. I've talked about it before and I've shared about it in various mediums, but I've always thought of financial planning, or as this financial planning firm, as being a bit of a teaching hospital, right? We want to give people the best possible service and experience we can, but we also want to make it a big portion of what we do here that we focus on developing the next generation. So we have to, anticipating the joining of two, new future financial planners on our team next year, and I think that's the most exciting thing for me.
Yeah, it's hard to beat. It's pretty exciting.
I'll throw in there as well, just because I'm being reminded by the bumps and thumps underneath us. I'm not sure if it's making it onto the podcast or not, but we're also doubling the office space. So we're taking over essentially the second floor of our building as well, or the same portion of our third floor that exists on the second floor. So some more exciting things to look at and get to experience here shortly.
Yeah, I'm looking forward to getting demoted to the second floor.
I mean, you'll at least have a lot of room to practice your golf swing.
There we go.
What about for you, Daniel? What's the big thing you're looking forward to in 2026?
I don't know. I think it's just laid a lot of groundwork for future success and momentum this year, whether it was, starting to be more engaged and responsible for the clients of the firm, or starting the curriculum for my CFP with the anticipation of taking it next year, or just embedding myself in the community and developing some of those relationships. I think this was a year of planting a lot of seeds that I'm excited to continue growing and working on next year. So hopefully passing the CFP, continuing to be impactful in the community, and just starting to see, I guess, more of the growth from the seeds that have been planted as we move into a number that has an even year on the end of it. So it makes me a little happier.
Yeah, man, I'll say, right, back to sort of the teaching hospital thing, it's been fun to see you develop over the last year and a half, and I gotta say, I'm pretty darn excited for what's coming for you next year.
Sweet, thanks.
Oh, well, I'll say thank you as well to all our fun podcast listeners and audience and clients and friends and colleagues who listen to this stuff and hear us chat every week. This is going to be our final podcast of 2025, so I'll be back at the beginning of 2026 to sort of set the stage for what we're doing in 2026, but for everybody who listens to this before the New Year's, Merry Christmas, have great holidays, have a great New Year, and we'll see you in 2026.
The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.